Hello everyone. Welcome to the course on the principles of income tax, which is going to be a part of your BCom degree course. And we are going to get into the first lesson of the session for the entire course, of course. And to have a briefing about the principles of income tax and about the course what we are going to deal with. This session is going to deal with the overview of income tax. Followed by that, we will be talking about the basic purview within which your income tax will come. Every individual or corporate or firm, whoever it is, who is going to pay taxes to the government, how they are going to be treated. We are also going to talk about the basic definitions as per the Income Tax Act. And before getting into the actual part of computation of your income taxes and computation of taxes under different heads, the provisions given as per the law, provisions given as per the guidelines, notifications and so on, we are going to have a small introduction about what is tax, what are all the different types of taxes, and what basis and on what basis the income taxes are going to be charged out. Not only income taxes, but then all the taxes for that matter. The basic on the taxes, tax systems, how tax systems works, and types of taxes that is getting collected, so on. So we are into the course on the principles of income tax, and we are going to deal with the basics about the income taxes for this particular course. Yeah. At the end of this particular first lesson, you should be able to understand and should be able to comprehend the types of taxes, what is the meaning of tax basically, the types of taxes that are going to be levied, the concept of the assessment, the concept of the assessment years, the concept of the assessment. There are two types of periods that we will take into account in case of your income tax. One is called as your assessment year, the other one is called as the previous year. What about all those things, like what is an assessment year, what is a previous year, because we need to understand both these things very, very clearly. Unless and until we understand both these things clearly, we cannot compute the income taxes for anybody. So we need to understand what is an assessment year, what is a previous year, and we should be able to know what are all the components of the income tax law. Because taxes, basically there are two types of taxes. We will be talking about that much later, but basically there are two types of taxes. One is an direct tax, the other one is an indirect tax. Both are governed by specific law. Direct tax, particularly the income tax, is going to be governed by the income tax law. So we should know what are all the components that are going to be a part of the income tax law. We should be able to recognize the meaning of a person, an assessee, who are all different types of persons, who are all different persons who will come under the purview of Income Tax Act and so on. And we should also be able to know the meaning and important terms used in the Income Tax Act. The whole of the Income Tax Act is based on the Income Tax Act 1961, and there are a lot of amendments that is taking place. How that works, how that has been created, how that is formulated, all these things are also going to be discussed out. And how basically the charge of taxes on income happens, and what is regarded as income under the Income Tax Act, because sometimes we will be dealing with what is an income without knowing that we are earning income. We think that we don't need to pay taxes for certain categories of income, but actually that is also going to be considered under the purview of Income Tax Act. So what are all going to be the things that are going to be inside the Income Tax Act, what we have to take into account as income, what not to be taken out as income, all are going to be understood properly. And basically the computation part of income tax, how gross total income is going to be arrived at, and what are all the components that we will have to take into consideration, what are all the components we have to dwell upon to arrive at the gross total income, and then what are all the different tax rates that are applicable, and different components of total income, the purposes of determining the total income of an individual. All these basic concepts about income tax is going to be dealt out in this particular session. Okay, now this particular chart that is on your screen will give you the components that are going to be taken into account on arriving at the income taxes, and the basic concepts that we'll have to understand before getting into the act, what act says. Okay, so basic concepts are divided into 4 parts. The first one is going to be the component of income tax law. What constitutes income tax law? Who will be enacting it? Who are all part of it, and who will contribute to it? That's going to be the first part. The second part is going to be for steps for computation of income tax liability. Okay, for an individual, for a person, how income taxes are going to be computed. So you are going to talk about the computation part of your income tax, total income, and then we will be talking about some of the basic definitions we should understand when it comes to the question of income tax as a subject. And then we will be talking about this basis of charges and the rates at which the income tax is going to be charged out. So 4 components, 4 basic concepts, 4 divisions of basic concepts are going to be dealt out in this session. First one is going to be the component of income tax law. It constitutes of Income Tax Act 1961, which is the basic law which is governing the entire income tax in India. And then we will that is going to be supported by the Annual Finance Act, and the income tax rules that's going to be amended every now and then. Basically, it will be amended once in a year at least. Not at least, maybe when there's going to be a change in the Annual Finance Act, Annual Finance Bill, the rules and regulations might change, so we will have to know about the income tax rules. And all these rules are going to be disseminated through the circulars and the notifications. So these notifications and circulars issued by the tax board, income tax board, or income tax authorities, that's also going to be another important component of income tax law. And finally, the legal decisions on the payment of tax, how to pay it, whom to pay what amount of tax, If not paid, what will happen? All these are also going to be a part of your income tax law. So component of income tax law constitutes of 5 components. One, the Income Tax Act. According to the provisions given in the Income Tax Act, the computation of income taxes will be made out. Then the Annual Finance Act, where the rates of taxes and the rules and regulations are going to be changed out, and basically the rates of taxes are going to be defined there. And third one is the rules. Fourth one is going to be the notifications and circulars through which the informations are going to be disseminated, and the legal act or legal decisions related to taxes are going to be a component of the income tax law. Second part, the steps for computation of the total income and the tax liability constitutes of 6, 7, 8, 9 components actually. Okay, almost around 9 components. First step is going to determine the residential status, because the residential status of an individual will definitely define about what is going to be the tax liability that an individual has got. To give an example for it, maybe if an individual is going to be a non-resident individual, non-resident Indian, he may be exempted from payment of certain taxes. Okay. Likewise, if he is going to be a resident individual or Indian, he will be asked to pay a lot of taxes. Not lot, at least to the extent his income is going to be taken into consideration. For that, the provisions will change between the NRI and resident individual, resident Indian, and so on. So first step is going to be to determine what is going to be the residential status of an individual. Next step we are going to talk about is the classification of income under the different heads. We will be talking about that a little bit in detail a little bit later, but to say a few heads, basically there are going to be 5 heads of income that an individual can have. One from the salary, the other one is from the house property, third one is from the capital gains, fourth one is going to be from the business or profession, then about your other income. So 5 different heads are going to be considered. Incomes earned under different heads are going to be classified, and then certain rules, regulations, provisions given as per the Income Tax Act is going to be given upon, and you are going to talk about computation of total income. So basically, classification of income under different heads are going to be the second step that we are going to talk about. Third one is the computation of income under each one of the heads. Okay. After classification, under each one of the head, we are going to have the income determination or computation. After that, sometimes within this different heads, we may be clubbing the income. Sometimes we may be clubbing the income of 2 individuals together. Say for example, if a minor person has got an income, this income can be clubbed with the parent's income, maybe father or mother, something like that. Or suppose if the income of the spouse is going to be there, that can also be clubbed together. So clubbing of income is going to be the next step, and then setting off on the carry forward of your income is going to be the next step that could be happen. Okay. Maybe setting off in the sense, suppose if I have got, if an individual has got, let us say, house property. Generally, when there is going to be a let out income from the house property, that is going to be treated as income, and that has to be charged out. That has to be computed for your income tax. But then, suppose if an individual is going to live in a self-occupied house, but then there can be some losses on self-occupied house. Say for example, if an individual is going to construct a house by taking a loan, the interest is going to pay, the capital redemption that is going to make, that is the repayment of loan that is going to make. Both these things can be taken up as the loss on the house property. This can be adjusted with the other income. Okay. So, to benefit the individual, the government has done this kind of, the Income Tax Act has given certain provisions for setting off of the losses, setting off of the income. Okay. So, in that sense, your income, set off of the income is going to be the fifth step involved in your computation of income. Then, sixth step comes to arriving at the gross total income after adjusting for all the income and the losses or the extra income and all these things clubbed together. You will be arriving at the gross total income. And then, if at all an individual is eligible for deductions, not all the individuals will be eligible for deduction. So, for eligible individuals, deductions from the gross total income can be made as the next step. And then, after deducting for all these things, the computation of tax liability, computation of taxes will take place, and finally the computation of tax liability, how much of tax has to be paid by an individual, will be given out at the final step. So these are all going to be the basic steps involved in computation of taxes, tax liability. And before getting into that part, we need to understand some of the important definitions given as per the Income Tax Act. I have just made a list of some important definitions only on the screen as of now, but we will be discussing more about these definitions in details as we progress upon. We need to understand who is an assessee, what is an assessment, who is a person according to Income Tax Act, what is an income, and basically, because the income that is going to be earned in India is going to be taxable, we need to also define what is India, who is a resident Indian, who is a non-resident Indian, and so on. So these kinds of definitions as given by the Income Tax Act is also going to be discussed out in detail. And the last part is going to be the basis of charges. Charges of income, on what basis the charges are going to be taken up, and the rates of income tax is also going to be given out at the outset of this particular session. Now let us get on to the meaning of tax. We should understand what is tax basically, because tax is a major source of income for government, and in a country like India, where a mixed economy system of economy is working, and democratic system of political system is in existence, we have to depend on the public-private participation model. So private people like you and me also have to contribute a lot to the smooth running of the economy. So tax is a major source of income for the government from the private people like us. So we need to understand what is a tax basically. So a tax is a compulsory contribution from the person to the government to defray the expenses incurred in the common interest of all the people without reference to the special benefits conferred. So for meeting out various expenses of the government, the major source of income is going to be the tax. And tax as a compulsory contribution for the wealth of the person, from the wealth of the person or a body of persons for the services of public power. So for meeting out the expenses of the common expenses basically for development of infrastructure, for development of telecommunications, roadways, railways, for administration, for running the government, they need money, and this is going to be collected from as contribution from the public of the wealth of a person or by the body of persons or something like that. And this is the share of income of citizens which the government, normally called a state, appropriate in order to procure for itself the means necessary for the production of general public services. And that's what I was referring to in the last sentence. The government need to build the infrastructure, build the administration, run the government. So for all these things they need money. So this money is going to be collected from the citizens as a compulsory payment in the form of a tax. The tax is a compulsory charge imposed by the public authorities, irrespective of the exact amount of services rendered. I mean, this will be non-proportional to the services that's going to be imposed. And that's why the tax is a compulsory charge imposed by the public, by a public authority, rather the government or the local authorities or whatever it is, irrespective of the exact amount of services rendered to the taxpayer. So generally the taxes collected from the person will be disproportionate, non-proportionate, or whatever the way you want to call, you can call, and that's going to be a little amount of money that's going to be collected to meet out the expenses of the government in return for the services that is provided by the government. And sometimes in the meantime, suppose if somebody is not going to pay the required amount of money, the penalty will also be charged for the legal for the breach of the legal duties and things like that. So a compulsory payment, that's what is going to be the tax. When the tax authorities or the government authorities ask for the taxes, it's going to be definitely paid. It has to be definitely paid by the individuals. So, I mean, even though it's going to be a compulsory payment that has to be made by the public, like you and me, it's not going to be collected in a very, very haphazard manner or without any system or something like that. So what they do is they follow certain system. The government, when charging their taxes, they will be trying to have a good tax system. So a good tax system should have all these 7 to 8 or rather 8 important characteristics, and government will try to see to it that all these 8 important characteristics are all the time kept in mind when they are forming a good tax system. So it should be with all these 8 characteristics. One is the equity, there is going to be certainty, economy, automatic stabilizer, convenience, redistribution, flexible enough, and not discourage work. Okay, so let us just have a small hint on all these things. First one, a good tax system should follow the principle of equity. In the sense, it should be based on the ability to pay taxes. Everybody should pay tax depending on their ability. That's why the direct tax system, whatever we follow now in India, it is a progressive tax system where, when you are going to have little amount of income, you will pay little amount of tax. When you are going to have lot of income, you are going to pay lot of taxes. So there should be some kind of an equity based on the capacity of or an individual's ability to pay taxes. The taxes should be collected. So basically, any tax system should have this principle of equity in its mind. And a good tax system should always have a kind of a certainty. Everybody should know their tax liability when the rules and regulations are formed out. A clear-cut certain income or certain taxability or certain liability should be computable. Okay, there should not be any haphazard or a Confucius way, or it should not be creating havoc, something like that. So it should have some kind of a certainty. Any tax system should have economy. The cost of collection must be kept at low. It's going to be from the administrative aspect of the government, but still what they have to do is they have to see to it that not too much of money is going to be spent on collection of these taxes. So it should follow the economy also. The economy should be from the government side. It should be automatic stabilizer. Should have a stabilizing effect on the national income level. When the level of national income is lower, maybe some extra taxes might be put out. When when they are going to have lot of income, maybe the government will try to have a little amount of tax getting collected. So it acts as an automatic stabilizer. Whatever money that is required, that alone will be collected. Unnecessary money will not be collected in the form of taxes. So that should be the basic criterion with which your tax system should work. It should be convenient to pay. So must be easy to collect taxes. From the government side, it should be easy to collect taxes. So that's the reason why today we have got all this digital payment, digital side, filing of taxes is also going to be made out on a portal basis, whether direct or indirect, whatever it is going to be based on the portal basis only. And a taxation should be able to or enable some kind of a redistribution of wealth from rich to the poor. That's why we are following, as I told you, the progressive tax system. So, lot of people who have got lot of income or people who have got lot of income, they should pay more. People who have got reasonable income, they should pay less. And people who have got no income, they need not pay income tax at all. So with that redistribution, what they are trying to do is, they are going to take a lot of money from those rich people and give it to the poor people for their basic infrastructure. So that should be the characteristics of a good tax system. And it should be flexible enough, in the sense that the chargeable to suit the economic conditions. If the economy itself is in poor state, how will the all the people will pay taxes. And if the economy is flourishing, maybe you can collect a lot of taxes from the people. So it should be flexible enough to pay, to collect or to charge more amount of taxes if required, less amount of taxes if not required, and things like that. And it should not discourage the investment. Okay, you should have a good system to encourage investment. That's the reason why we in India, according to the Income Tax Act, a lot of rebates and a lot of exemptions are being given those who are investing in long-term investments in housing sector and so on. So these are the important aspects that a tax system should consider, and this is how any tax system should work in the given situation. And now coming to the point of types of taxes. There are two different types of taxes that you can have in an economy. One is the direct tax, the other one is the indirect tax. What makes the difference between direct and indirect tax is so simple. The tax burden or the chargeability of tax, that makes the difference between direct tax and indirect tax. How? The chargeability of taxes will be direct on the person who has to pay tax in case of a direct tax system. That is something like this. The person who is liable to pay taxes will pay taxes direct to the government without any intermediation. So some of the examples are given listed out in the slide, like your income tax, your corporation tax, capital gain tax, capital acquisition tax, wealth tax. All these are some of the examples of your direct taxes. Indirect tax, something like when people have to pay taxes on their consumption. We pay taxes, knowingly or unknowingly, on all our consumptions we pay taxes, and that's going to be a kind of an indirect tax. And in India, after 2017, it is indirect. GST. That's the indirect tax we pay, and on consumption of every type of goods and services, we are paying this kind of GST. So what makes this difference is that we pay taxes not to the government on our consumption, but to the service provider or the seller to whom or from whom we are going to take the services or the products or goods. In turn, these service providers and the good seller, they will be paying it to the government. So government will collect the taxes from the public indirectly through the intermediaries, like your service providers and your goods and service sellers. So that way it is going to be called as indirect tax. Previously we were having VAT, now we have got GST, excise duties, now it is not there, customs, it's still in there, stamp duties. Now all these are going to be something like your indirect taxes. Examples for it. Both direct and indirect taxes have got their own advantages and disadvantages. The advantages of direct tax system is that it's based on the principle of equity, certainty and economy. It is going to be convenient to the taxpayers also. They can pay the tax direct to the government without any intermediation and act as an automatic stabilizer. If you are going to have more income, you will have to pay more taxes, and that will be good for the economic growth. So it will automatically act as an automatic stabilizer. But it has got its own disadvantages. Disadvantages is that as it is going to be, it's going to raise the work is discouraged. Work is discouraged. When too much of taxes are going to be levied, probably you will not invest, you will not work, you try to evade taxes, and all these things can happen. There's going to be a serious problem of tax evasion can be there. There can be discouragement of investment can take place. So you need not, I don't want to earn, not want to pay more taxes, so I don't want to earn more, so I don't want to invest, so I don't make the investments. So indirectly that will affect the economic growth. Okay, so that way your disadvantages are there for the direct tax. In the indirect tax phenomenon, the advantage is that the cost of collection is going to be very, very economical, because on consumption you are going to collect taxes. On every consumption you are going to collect taxes, and that is going to be paid by the respective sellers or the service providers. So the contact point is going to be very, very less, the sellers and the service provider. And it is easier to extract from the public. It's going to be less sensitive, in the sense it's going to be collected along with your price of the product itself. So it's going to be very sensitive to, less sensitive to. And then, less sensitive in the sense they are, without knowing that we are paying taxes, we will be paying taxes when we look at the bill itself. So we consider it has to be paid, and we pay it. So it doesn't discourage the work, and it is going to automatically work out. It will encourage spending. It will maybe you can have more amount of income being generated for the government. All these advantages are also there. Disadvantage is that it is inflationary or deflationary. More amount of indirect taxes lead to more of cost of product getting increased out, cost of production getting increased out, or cost of sales getting increased out, and as a result the product cost will increase. As a result your inflation can happen. So it is more inflationary or deflationary, and it is going to be regressive in nature. That's the major disadvantage as far as the indirect taxes are concerned. Even if you are not going to have an income, even if a person is not going to have an income, if he is going to consume, he has to pay tax. So it is non-equitable. And almost you are not going to have any, the yield is going to be very, very low on these kinds of the indirect taxes, and it is hard to predict the yield also. Okay, so these are all going to be some of the disadvantages of your indirect taxes. Yeah. Now, as I was talking about two different types of taxes, this is going to be the difference. What you see on your screen is going to be the difference between the direct tax system and the indirect tax system that you can have. The point of differences is that the incidence and impact of taxes. In case of your direct tax, the tax is said to be direct, and when the impact and the incidence of tax is going to be on the same person. But here on the indirect tax system, in the third column, whatever is there, it's going to be something like this. The impact is going to be on one person, and the incidence is going to be on the other person. For example, impact is going to be on the consumers, but the incidence, those who are going to pay tax, is going to be the seller or the service provider. So incidence and impact is going to be different in case of your indirect tax. Burden of tax. In case of direct taxes, it is imposed on the individuals, organizations, and burden of taxation cannot be shifted from one person to another. But then in case of indirect taxes, it is imposed on commodities, consumption, and it allows the tax burden to be shifted. So consumer paying it to the the seller or the service provider, and service provider will pay to the government. So shifting is going to be happening in case of your indirect tax system. And the viability of payment, the direct taxes are based on the income earning capacity of the individual or the people. But in case of your indirect tax system, it's going to be based on the consumer and on consumption of goods and services, commodities and services, irrespective of the financial ability. The MRP is inclusive of all taxes. So everybody have to pay taxes in case of your indirect tax system. Administrative viability, as far as administrative, the way in which the taxes are collected and things like that are concerned, the administrative cost of collection of direct taxes are more, and because they have to take it straight away from the individuals, every individual has to be tracked out, and everybody has to be given a kind of notification and things like that, and your taxes will be collected on an individual basis. But then in case of your indirect tax system, the collection of indirect taxes is very, very less, because it is going to be along with your consumption, along with your the MRP, whatever price we pay, and that is going to be collected from the seller or the service provider then and there. So it's going to be less costly when it comes to the question of indirect taxes. And both the taxes, both kind of taxes, it is levying penalty on the assessee. But what makes the difference is that it is levied on the assessee directly in case of your direct tax system, but in case of an indirect tax condition, the consumer does not be penalized, will not be penalized, but then the supplier of the goods and services will be penalized. So incidence of tax is going to be on different person, and impact is going to be on the different person. So the person, the supplier and the service provider will be penalized for non-payment of taxes in case of your indirect tax system. Okay. Now, answering to this question on why the taxes are levied. The taxes are levied because of two reasons. This is going to constitute the basic source of revenue for the government. So, majority of the government, whatever country it is, majority source of income for the government is going to be from taxes. So, taxes has to be levied. Particularly in a country like India, where you have got mixed economy system of working, democratic system of government is in existence, public-private participation is important, and public services are going to be managed by the government by collecting taxes from the private people like you and me. Okay, and the revenue that is going to be collected through this taxes are going to be utilized for meeting the expenditure of the government, like the defense, the provision of education, healthcare, infrastructure facilities like roads, dams, railways, telecommunication, all these types of services are going to be provided. The public services are going to be provided through these taxes that is going to be collected. So that's the reason why we need to and the government has to depend on the taxes for a very important, for all these very important reasons. Okay. Who has got the power to collect the taxes or levy the taxes? Okay, now the Constitution of India in Article 265 lays down that no tax shall be levied or collected except by the authority of law. So, government will appoint certain authorities. Those authorities can only levy the taxes and collect the taxes. Accordingly, the levy and collection of any tax, a law is needed, and that's why we have got GST law, GST Act, Income Tax Act, and so on. So the law is needed, and it needs to be framed by the government. So most of the time the government will frame, not most of the time, all of the time the government will frame out all the rules, regulations, framework, provisions, laws, acts relating to the taxes. So the government authorities will implement it, government will levy the taxes. And the Constitution of India gives the power to levy and collect taxes, whether directly or indirectly, to the central government or the state government, sometimes both by central and state government. The parliament and the state legislatures are empowered to make laws on the matters enumerated in the 7th schedule by the virtue of the Article 246 of the Constitution of India. And what it says, 7th schedule of Article 247 Constitution, 3 lists which enumerate the matters under which the Parliament and the state legislature have the authority to make laws for the purpose of levy of taxes. So they are going to be something like list 1, list A, list B, list C. Something like first one is going to be your union list, where the Parliament has exclusive power to make laws on the matters of constituted in the union list. Central government will make that. State list, the legislature of any state will make that particular list, and they have got powers to levy and collect the taxes in the matters related to the things that are specified in the state list. And there's going to be a concurrent list where you are going to have this GST under this concurrent list, where the Parliament and the state legislature have the powers to make the law of law to levy taxes and collect taxes, and all the matters related to the taxes are going to be concurrently handled both by the central government and state government. So there are 3 lists. So according to the Constitution Act, Article 246, there are 3 lists. According to 3 lists, every state government, central government, and sometimes jointly by state and concurrently by state and central government, the taxes are going to be levied. So they have got the powers to levy taxes as far as India is concerned. Okay. As I was saying in the beginning, the discussion on the income tax law in India is going to be taken out now. The components of income tax law is going to be of 5 different components constitute the income tax law. Number 1 is your Income Tax Act 1961. This is the act through which the basic income taxes are going to be levied, and the entire income tax is going to be governed by this Income Tax Act. Then Annual Finance Act, the income tax rules, circulars and notifications, and the legal decisions relating to the income tax. Let's go one by one. In the sense, first one is going to be your Income Tax Act. Income Tax Act 1961. The levy of income tax in India is governed by this particular act called as Income Tax Act 1961. It is applicable to whole of India, and it came into effect even though the name of the act is going to be 1961, it came into effect from 1st April 1962 onwards. Okay, and it contains section and subsections, clauses and subclauses. So when each part of the section is independent or of each other and others is not related with the when each part of other such paras or such a part are called as clauses, and subsections on each on the other hand are going to be there, and it is something like this. There are going to be different sections. Take it this way. There are going to be a lot of sections independent of each other, not related to each other. Such parts are called as the clauses. Okay, and there will be subsections which are going to be a subclause of a particular section is going to be called as a subsection. So that is divided into so many number of parts. In a section may have a provision, provisos, and explanations on the provision. So the provisos to a section or subsection or a clause spells out the exceptions or conditions to the provision contained in the particular section or the subsection or whatever it is, or the clause or something like that. So the explanations and the provisions relating to the section are given in the proviso. So that is the provisos spells out the causes where the provisions contained contained in the respect, say for example section 2, section 4, section 8, something like that. A separate section will be given out and subsections will also be given out, and within that section the explanation on each one of the categorization or the tax component will be explained out in a very detailed manner. And the Income Tax Act 1961 undergoes change every year. Okay, while every year with additions and deletions or change, the substitution brought by the Annual Finance Act passed in the Parliament. Sometimes in the Income Tax Act 1961 is also amended through other legislations. So basically amendment will also take place, and then the Finance Act will also be prompting the Income Tax Act change every year. So generally in the parliamentary session, that is presenting the finance bill, that section of the finance bill will have provisions relating to the Income Tax Act. So the annual changes, generally the rates of income taxes will be changing, and some subclasses of income taxes will be changed out only through the Finance Act. So amendment in the Income Tax Act and annual changes in the Finance Act both will constitute to the change in the Income Tax Act. Now the Finance Act, every year the Finance Minister of the Government of India introduces the Finance Bill in the parliamentary budget session, and when the Finance Bill is passed by both the houses of the Parliament and gets the assent of the President, it becomes the Finance Act. So amendments are made every year in the Income Tax Act 1961 and other tax laws by the Finance Act every year. So whatever changes that is happening on a year-on-year basis. All these things are because of the changes that is proposed in the Finance Act. The first schedule of the Finance Act contains the 4 parts, which specifically which specify the rates of taxes. Part 1 of the first schedule to the Finance Act specifies the rates of taxes applicable for the current assessment year. Accordingly, Part 1 of the first schedule of the Finance Act 2022 or 2023 specifies the rates of taxes for the assessment year 2022-2023. Okay. Second part specifies the rates at which the tax deductible at sources for the current financial year. So the tax deducted at source. So the provisions related to that is going to be made out in the part 2. And then accordingly, the part 2 of the first schedule to the Finance Act 2022 specifies the rates at which the taxes are deductible at source for the financial year. Part 3 gives the rates for calculating the income tax for deduction, deducting the taxes from the income chargeable under the income tax different heads of salaries basically, and computation of advanced taxes for the financial year 2022-2023. Part 4 gives the rules and regulations for computing the net agricultural income. So that way the Finance Act is going to be presented out. Income tax rules. The administration of direct taxes is looked after by the Central Board of Direct Taxes, CBDT. Okay. Now this CBDT is empowered to make rules for carrying out the purposes of the Act. So they are the persons who are empowered to make the rules. For the proper administration of the Income Tax Act 1961, the CBDT frames the rules from time to time, and these rules are collectively called as the Income Tax Rules 1962. But that will also be keeping on changing year after year. The rules also have sub-rules, provisos, explanations, as we were talking about in the Income Tax Act. Income tax rules will also be having provisos, subsections, sections, explanations, and so. And it is important to keep in mind that along with the Income Tax Act 1961, these income tax rules should also be studied. So these two things go in tandem, right? The Income Tax Act and Income Tax rules goes in tandem. So both these things have to be studied across. Both these things have to be learnt across to learn the subject on income tax. And there will be some circulars and notifications. Circulars are issued by CBDT from time to time to deal with the certain specific problems and to clarify doubts regarding the scope and meaning of certain provisions in the Act. Circulars are issued for guidance, and that is going to be the official document, and it is applicable for both officers and for the assessees for a particular period of time. And the department is bound by the circular. Department of Income Tax is bound by the circular, while such circulars are not binding on the assessee. They can take advantage of beneficial circulars. So assessee, every income tax rules and regulations are kept. Have been developed by keeping in mind the assessee into consideration. Whichever is beneficial to the assessee, that can be opted by the assessee. So that way That's going to be the advantage that the assessee has got. But then the rules and regulations have to be strictly followed by whatever that's been given in the circular, it has to be followed by the officers of the department. And the notifications are issued by the CBDT to give effect to the provisions of the Act, and the CBDT also empowered to make and amend the rules for the purpose of collecting or making the whole process of levy and collection a bit easy. The notifications are made out by the CBDT at their will. And there are a lot of case laws available as far as the legal decisions are concerned. The case laws refers to the decisions given by the court. In case if there is going to be any kind of discrepancy between the CBDT and the assessee, the department and things like that, it may be taken to the court of law, and the judges in the court of law would have dealt that particular case and given their judgment. The study of these case laws is going to be an important and unavoidable part of the study of the income tax law. It is not possible to for the Parliament to conceive and provide all the possible issues that is going to be there in the implementation of any act. Hence, the judiciary will hear the particular disputes and between the assessee and the department and the authorities, and they give the decisions on their various issues. So that forms the basis. The Supreme Court is going to be the apex court for the country, and the law laid down by the Supreme Court is going to be the law of the land. So the decision given by the various High Court, Supreme Court will all apply to the respective states in which such High Courts have jurisdiction. So finally, in case of disputes and things like that, the judgments that is given by the court, that forms the basis for the further cases. Okay, so these are all going to be the most important components of your income tax law. And income tax is a tax levied on the total income of the previous year of every person. So now we are actually getting into the Income Tax Act. So what is income tax? Now, income tax is a tax levied on it is levied on the total income of a person who have earned during the previous year. So section 4 of the Income Tax Act will is dealing with that, and it says the provisions relating to the total income. So the person, when I mean a person in Income Tax Act, it's not the individual alone. It includes all individuals, Hindu undivided family, association of persons, body of individuals, a firm, a company, and so on. So, whoever is an artificial person in the eyes of the law, they are going to be treated as person. Total income and tax payable. How it has to be looked in that is that income tax is levied on the assessee's total income. Total income constitutes all 5 classifications of income that we are going to deal about in the near future. So such total income has to be computed as per the provisions contained in the Income Tax Act 1961. So Income Tax Act has defined the total income, how to arrive at the total income. They have given the provisions relating to that. So according to the provisions given in the Act, the total income has to be computed, and accordingly, upon the total income, the total tax payability will also be defined. Now, getting on to the aspect of total income. How to arrive at the total income? Steps for computation of your total income and tax liability. I have already told you in the beginning. I'm just going to give you a complete step-by-step approach that has to be followed for arriving at the total income of an individual. The total income of an individual is going to be determined by following these 9 steps. First one, determine the residential status of an individual. Then, depending on that, classify the income under different heads. Compute income under each of the heads. Club the income. Suppose if you have got any losses, such losses can be carried forward or can be set off against different other heads. So setting off, carry forward and setting off of other losses can also happen. Then compute your total gross income or gross total income. From there, if at all an individual is eligible, can go for deductions from the total gross total income. And then computation of taxable income will be enforced. From your computation of taxable income, your net liability of taxes are going to be determined. Now, these steps are going to be discussed out in detail. First one, determination of the residential status. We will deal about the how to determine the residential status of an individual with some numerical examples also in the next session. But for now, the residential status of the person has to be determined as the first step of ascertaining the income of an individual. The residential status as per the Income Tax Act 1961 can be classified into 3 actually. Okay, one is going to be, in the case of an individual, the duration for which he is present in India. That is going to determine the residential status of an individual. Okay, suppose if an individual is staying for a specified number of days in a year, he is going to be categorized as resident Indian. If he is less than the specified number of days, he can be non-resident Indian or resident but ordinary resident Indian, something like that. So, depending on the number of days a person is living in India, is staying in India, that makes the most important point in determining the residential status of an individual. So, based on the number of days spent by a person in India, he may be a resident Indian but ordinary resident Indian. At the same time, he can be resident but not an ordinary resident Indian. There is a subtle difference between these two things. The conditions which we are going to look in future, that will determine that. And the non-resident Indian. Okay, so 3 categorization of residential status are going to be there as far as individual is concerned. This residential status of a person determines the taxability of the income. For example, income earned and received outside India will not be taxable in the hands of a non-resident Indian. But the same thing will be taxable in case of a resident Indian. Resident and ordinary resident Indian. Okay, again, a deemed resident is always a resident but not ordinary resident in India. So, depending on what is the status of the residential status of an individual, certain income is taxable, certain income is not taxable, and that's the reason why the first step we have to determine what is going to be the residential status of an individual. As I told you, this slide or this particular diagram will give you an understanding on what are different categorization of different categorizations of individuals are concerned. Then residential status individuals are concerned. Then classification of income under different heads. A person may earn income from different sources. Sometimes, and the same individual can have multiple sources of income. But majority of the time, one single source of income is going to be the source of income for an individual. A salaried person who earns income by way of salary, suppose if he is going to be on an employment, he also get an interest from the bank savings account or a fixed deposit. And suppose if he has got a share, he may be getting a dividend. Something like when he is going to have a house property, maybe he would have earned, or ancestral properties could be there. He would have rented it, so house property, rent from the house property can be there. So income from house properties can also be there. And the same house property can be sold out, and in the meantime he may be getting something called as a capital gain. So multiple sources of income could be possible for an individual. So in that scenario, we have to determine what is going to be the income, gross total income of an individual from different sources that an individual can have. So under the Income Tax Act 1961, for computation of total income, all income of taxpayer are classified into 5 different heads of income. This is what it is. Under the head of salaries, income from house property, profits or gains from the business or profession, capital gains, income from capital gains, and chargeable under different other income, other sources of income. So an individual can have income from all these sources, possible to have it, but then multiple sources could be there, but at least from one source he will definitely have an income. So such income, which is going to be under all any one of these particular heads, will have to be computed, will have to be classified, and it should be considered for payment of income tax. The taxpayer has to classify the income earned under the relevant head of income, and he has to compute his taxes. Okay, I'll reiterate on the 5 different heads of income. 1, salaried person earns his taxable income under salary. Rental income could be possible for the house property, person who has house property. Who is doing a business or profession, they can have income from profits or gains from business or profession. And suppose if you are going to have a sale of a capital asset, like land or a building or something like that, there the shares, even shares, your financial securities, that also will come under the head of your capital gains. And any other things like interest, dividend, all these things will be treated under your income from other sources. Okay, so these are all different 5 income sources of income that an individual can have. So to give you an idea, 5 different heads are listed down in this particular slide. Salaries, income from house property, income from business, profits or losses from business, income from capital gain, and income from other sources. Now, computation of income under each head has to be done. Income is to be computed in accordance with the provisions governing the particular head of income. Because sometimes when you are going to have salary, exemptions might be given to the salaried people. Some of the exemptions might be given to the salaried people alone. Some of the exemptions might be given to the persons who are doing business alone. So, to give effect for that, exemptions, to treat these exemptions separately, there are certain incomes which are wholly exempted from income tax. So, these incomes have to be excluded and will not be forming part of your total income. Also, some incomes are partially exempted from income taxes. So, these incomes are excluded only to the extent of the limit specified in the Act. For example, let us say housing allowances. Some of the allowances are going to be completely taxable, some of the allowances are partly taxable. So, you will have to classify those things under different heads, and you should take into consideration only those parts that are going to be taxable by a person, on a person. Okay. And deductions, there are deductions and allowances prescribed under each one of the head. Separately it is given out. So, these deductions have to be considered before arriving at the net income chargeable under each one of the head separately. That's why you have been given with 5 different heads of income and 5 different classification of income. Next step, it has to be clubbing. In case individuals or income tax is leviable on a slab system on the total income, the tax system is progressive. As income increases, you will have to pay more taxes, and the income decreases, you will have to pay less taxes. Some taxpayers are going to be higher income categories or brackets, and they have to the tendency to divert some of their portions of their income to their spouses and minor childs, etc., to minimize this tax burden. So, this kind of clubbing of income can happen in order to prevent such avoidance of taxes and things like that. The clubbing of income, provisions relating to the clubbing of income have been incorporated in the Act, under which the income arising to certain persons like spouse, minor child and things like that have to be clubbed out, and it has to be shown as one person's income according to the Income Tax Act. As I told you in the earlier session, there can be setting off or carry forward of income or losses from one head to the other. Carry forward from one year to the other can also happen. This has to be effected upon. See, for example, if I have got a house property, as I told you in the beginning, for construction I would have taken a loan, and this loan, repayment of loan and the interest payment is going to be a expenditure for me or loss for me. Such losses can be offsetted by the other income that I've got. So, that kind of a setting off and offsetting of the losses can be taken up as the next step number 5. And step number 6 is going to be the original computation of total income. After taking into account different heads, after deductions, exemptions under different heads, after clubbing off, after setting off all the allowances, deductions, after all these things are made, your total income is going to be arrived, and that is going to be called as gross total income of an individual. For example, there can be deductions, there can be some exemptions, For example, as far as deductions are concerned, with respect to in respect of certain payments, the exemptions can be, deductions can be given. For example, you pay for your income tax, life insurance plan, or you pay for your contribution to provident fund. These are going to be given as certain exemptions to your payment of taxes. Likewise, there are certain, with respect to certain income, also sometimes the exemptions can be given or deductions can be given. For example, the employment of new employees, the royalty income, etc. are going to be, etc. for the authors. For certain books, other than the textbooks and things like that, there can be some exemptions given. And with respect of other income, the deductions can be in the form of interest on deposits on savings bank account, interest on deposit after a certain particular limit. Within that particular limit, if you are going to get the interest and things like that, say for example 10,000 rupees a year or so, within that income limit, you may be exempted, or the deductions can be given out. Other deductions like deductions in case of let us say personal disabilities, or maybe for certain expenditures, some deductions can be given. So that all these deductions are going to be deducted out, and you are going to arrive at the total income of an individual. So comprehensively, this particular diagram will give you the steps involved in arriving at the total income, or whatever steps that I was saying you as of now, till now, this is going to be pictorially given out, and you are going to arrive at the total income. After the total income, applicable tax rates are going to be given out. Now, I will go to yes, this is a model for the tax rates. Applicable tax rates for individuals, undivided families, association of persons, body of individuals. For the assessment year 23-24, the tax rate goes like this. When there is going to be a total income does not exceed 2,50,000 rupees, you need not pay any taxes. And the tax rate on the next column, the second column is given out, need not pay any taxes. Where the total income exceeds 2.5 lakhs but does not exceed 5 lakhs, on that amount you will have to pay 5% of it. So you will have to pay 12,500 rupees. Suppose if your income is going to be up to 5 lakhs. Where the total income exceeds rupees 5 lakhs and below 10 lakh rupees, above 5 lakhs, whatever income comes, you will have to pay 20% of it plus 12,500 rupees. And above 10 lakh rupees, 1,12,500 rupees plus 30% of the amount above your amount exceeding 10 lakh rupees have to be paid out. So this indicates that there is going to be a progressive system of taxes are going to be taken into consideration. With that, we will stop this session, and we will come back to the next session during the next week for various definitions and things like that. And so we will end the session now, and all the best.